Hi, everyone. Knox Ridley here, portfolio manager of the IO Fund. We are a research company. We focus specifically within tech and in crypto, and we manage a live portfolio in real time where you can actually track how we utilize our fundamental and technical research as long-term investors. So what I'm going to do today is just show you a little bit of our broad market research. You know, every single market, bull and bear, is being driven by other markets. It's all interconnected. And so finding what markets are leading, the equity market helps you to, get emotions out of the way, provide proper context. And that's what we're going to try and do today. So what we're looking at here is the S&P 500. You're looking at a weekly chart. So every single bar represents 1 week's worth of price data. And the reason I'm doing this is because the bigger the chart, the more important the trend is and the more meaningful the signals are whenever they show up. And so what we're looking at are some momentum indicators that I track. This one specifically I use to find selling and buying zones, just exhaustion zones or supports, if you will. And so every time during this bear market we've hit this support zone, we've seen a pretty noticeable bounce, and we're on there again. And so this is a warning sign to bears, that every time that we've hit this zone, we see a pretty sharp reverse rally, which I think we're setting up for. The same thing with this momentum indicator. It's on a support zone where every time we've hit it, we've seen some kind of a bounce. You may be saying, hey, we hit these levels right here and here and here and here, and the market just kept going down ultimately. And the difference between this region and this region is the spread of this indicator. Keep in mind, it's picking up momentum. And so this is a moving average, a long moving average, and a short one. When the short one's below the long, you're in a bullish momentum market. And so you should expect a downtrend. And the reverse is happening right now. We have a really wide bullish spread as this indicator is hitting long-term support. So I think it's setting up. I think we're seeing some selling exhaustion, and I think we're going to see at minimum the unwind of this. Maybe we get one more push lower, but I think we're very close to seeing some kind of a noticeable trend reversal going into the end of the year. So if we go into the daily chart, the question is, well, what pattern is playing out? Because there's always a pattern playing out. And if you can identify in real time, it helps you to potentially forecast what might be happening, better risk manage accordingly. So the pattern that I see playing out, I like to start with what we know. And here's what we know. In June, we only have 3 waves up. Now, if this turned into 5 waves, let's say that we went down into here and just made one more higher high, that would give us a nice 5-wave push. And that's the market telling you that it's ready to reverse trend in a new bull market. But that's not what we got. We got a 3-wave move, which is why up in this region in our premium service, we were raising a lot of cash. Some of our members were confused why we were raising so much cash. And I kept saying on these webinars, we only have 3 waves up. Be very careful up here, right? So what's happened in reverse is we have 3 waves down. Now this also can turn into 5 waves. If we get a big bounce here and then get one more bigger low, we have 5 waves down, and that's not good. That's something that we would you'd see us talking about altering our risk profile just a little bit if that does happen. But as of now, we have a pretty clear 3-wave move. And so we have 3 waves up, 3 waves down. And so I'm thinking about what patterns would, what bigger patterns would this be playing out in? And there's 2 that I see lining up with some of the other markets that we're tracking. And the first is what you call an expanded flat correction. Now, this is suggesting that we're in actually a bigger bear market rally, right? That even this downtrend is part of a corrective rally that we should see play out probably into early 2023 and take us back up to the August highs. And what this corrective pattern looks like is a 3-wave move, right? Your first corrective wave, and then you have a retrace that goes below the start of this A wave. So A, B goes below the start of A. And when that happens, we tend to see a very powerful, sharp C wave move back up. And so this lines up very well with the bigger context of this bear market right now. The other scenario that I see playing out, potentially playing out, is that we are finishing off a very complex bear market pattern, one that we don't really see very often. But the final move of this pattern is a three-wave move, 1, 2, 3. And this final C wave is playing out in a five-wave move, 1, 2, 3. I think this would be the end of 3 today, maybe a little into tomorrow. And then we see a bounce probably into next week with one more low. And the targets that I have on my charts are right here. 3,600 to 3,555. I don't think that we have enough juice to go directly down to 34 from here. 33, 34, which are the next support zones that I have on my list. I mean, short of some kind of black swan, just news event, you know, if this is playing out within the normal sentiment of what the market is pricing in, you know, we should be seeing some kind of a bounce right here very, very soon. And even if we do see a bounce on one more low down into this region, I still think it's setting up for one of those two scenarios that I showed you going into the end of the year. So what would be the catalyst that would propel this? Like I said before, markets, they don't move, they don't operate in a vacuum, you know, especially these broad market macro, in a broad market macro sense. And the two assets that have been pushing this bear market are rates in the US dollar. We've been in a deflationary economic regime really since 1998. It's been a phenomenal bond market bull run. Deflation, bonds work really well in deflation, and it's pushed rates down to very, very historically low levels. Then all of a sudden inflation creeps up in a big way. No one wants to own a fixed yield in an inflationary environment. It makes total sense, right? Especially when real yields are negative, you're guaranteed to lose money as the bond continues to sell and the yield doesn't even make up for the inflation. So inflation forced the bond market to reprice the yields on bonds until we can get to a positive real rate return. And so what that means for equities as rates go up, the cost to refinance also goes up. So long dated assets, long duration assets, where you're basically, you know, owning a stake on future cash flow, they tend to get beat up the most. And tech is a long duration asset. A lot of these companies don't have earnings or cash flow, or very small earnings and cash flow. And so what you're doing is you're buying a stake on future cash flow and future earnings. And so once rates turn, we should see a reverse snapback. And I think that we're close to that. So let me show you this pattern that's playing out. This is TLT, the iShares long dated bond ETF. And very clear three-wave pattern from the March 20 high, 1, 2, 3, right? And this final C wave, like we said before, it's a five-wave move, very clear five-wave move, 1, 2, 3, 4, 5. Now, we see these patterns play out all the time. And the way that a five-wave pattern works out, if you think about the behavior within the crowd, it's the same pattern playing out. The third wave is when everyone realized they're in a downtrend, that they got to sell at any price, right? Everyone gets on the same side of the market. We see peak volume and peak momentum. And then the fourth wave, people who missed out, you know, they go ahead and try and get involved, thinking that the trend's going to continue. And it tends to, on the final fifth wave move before a sharp snapback. And this fifth wave will happen on less momentum, less volume and less momentum, which is exactly what we're seeing. This to me is a very classic five-wave pattern playing out. I think we can go as low as 96.50. Hopefully we don't go below there. That would spell trouble. But as long as you know, we start seeing buyers step back in, which I think eventually will happen. I mean, if you look at any of the market-oriented data on inflation, we're seeing a huge turn, even though the Fed's not really acknowledging it. And the bond market, especially the long duration bonds, they're focused on growth and inflation. That's what's driving, you know, long duration bonds. And eventually, the global growth fears will outweigh the inflation fears, and you'll start seeing bond buyers step back in, which I think is going to happen relatively soon. And that will push yields down. That would be one of the catalysts, I think, that would line up with, the broad market bounce that seems to be ready to play out within the next couple weeks. And then if we go to the US dollar, this is another asset that's been pushing equities down. As the Fed gets tight, this quantitative tightening, raises rates, basically it means that dollars are becoming scarce. And when dollars become scarce in an environment of fear, you'll tend to see the dollar go up. And what I mean by that is, the 10-year treasury is considered the risk-free rate of return. And the reason is because the US has never defaulted on their treasuries. And so whatever that 10-year is, the yield is considered that risk-free rate of return. And it's more than doubled this year. It's at 3.9, 3.8%. And so, that's made treasuries a lot more attractive, especially as of right now. And so, if what we're seeing is that foreign investors are selling their currency to buy treasuries with the dollar, and that in essence creates a supply issue with the US dollar, forcing it to go up. And the higher the dollar goes, the more difficult it becomes for emerging markets to pay back a lot of debts they've taken out. Also, 30% of the revenue in the S&P 500 is from international sales, and it continues to hurt international sales in the US. So that's just a very quick reason why a strong US dollar is hurting equities. And we're seeing the US dollar, it's at a 20-year high. You have to go back to 2002 to see it this high. And so what we're looking for is a reversal in the dollar to signal that equities are due for that bounce that we've been talking about. And so really since was August, this is our third attempt at putting in a top. The first attempt here failed at 107.5. This is the dollar index. I track this for the US dollar because there's just a lot of price data on it. The second attempt was here in September. And this one looked very promising. We failed around 107.5, strong reversal. And here we are again at our third attempt at putting in some kind of a major top and trend reversal. This one is promising for two reasons. One, this is a proprietary momentum indicator I created to help me find very meaningful divergences. And a divergence is where price goes higher, but the momentum goes lower, makes a lower high. And that typically precedes bigger turning points. This is the first time we've seen this on this level where, the momentum got a lower high underneath the oversold condition, the overbought conditions, excuse me. The other positive sign is this candle pattern right here. You see how the top of the wick all the way to the bottom of the wick completely engulfs the prior two candles. This is a bearish key reversal signal. It's called a bearish engulfing pattern, and they tend to occur right around meaningful shifts in markets. And we had a great follow through day today where we broke through a key support zone. So far so good, but look here, we have 1, 2, 3 supports to break before we get one more crack at 107.5. And if we can break below 107.5, then that'll be really good for equities. It'll be really good for crypto as well. There's a very specific inverse correlation between the strength of the dollar and crypto. So this is another market that we are watching. The more it goes up, the harder it's going to be for equities, specifically growth. And we're looking for that reversal in trend, which hopefully is playing out right now. So those are just a few of the markets that we're looking at right now. Hopefully that gave you some context to help you get a better idea of what's playing out right now, maybe keep emotions under check. And if you like what you see, we do I specifically do, about an hour-long webinar each week where we go over more broad market signals. We go over our proprietary hedge signal that helps us manage risk with an all-growth portfolio. And then we go into specific stocks, like tech stocks that we're looking to buy or sell, and crypto positions as well. And if that interests you, I recommend you checking out our site at theiofund.com. And my partner, Beth Kendig, I mean, she is the force behind our portfolio. We always start with fundamentals, with the fundamental thesis of the stocks in the tech field that make the most sense within the micro trends that they're participating in. And from there, we'll work our technicals on that and try to manage risk around that. And I recommend that you check out her free newsletter, which you can find on our free blog on our site. So thank you very much, and we'll see you next week.